So, welcome everyone to today's session. I'm going to be talking about environmental risk and its impact on banks' capital. My name is Nadia Alqassab. I'm currently a senior lecturer in Bahrain Institute of Banking and Finance, and I'm an ex-former investment banker and commercial banker. So this is my area and I'm passionate about it. So let's start talking about environmental risk. Now, the main question is, should banks hold more capital for environmental risk? Currently, we factor in market risk and credit risk. And you know what is credit risk, which is risk of default. Market risk is the valuation of financial instrument. But environmental risk is the topic nowadays worldwide on how to factor it in within banking regulation. Now, should we as banks consider it? The answer to this is simply yes. According to the IPCC Intergovernmental Panel of Climate Change, the 6th Zenith report, it mentions that anybody born after 2020, by the time they are, let's say, 70 years old, they will suffer a series of respiratory and cardiovascular diseases. And you might say to yourself how this links to banking on many dimensions. A, if the next generation cannot survive, we will not have the talent to carry forward our work as banks. And what we have learned in Banking 101 first year is that we as banks should adhere to GAAP accounting rules. Banks should stay going concern. They should live forever. And they should give the same equal opportunities to the next generation that we were given once upon a time. That being said, banking is the core entity in every nation that determines financial stability. Hence, we as banks, we should have enough capital to withstand unexpected losses. You see, as banks, when the loss is expected, we factor it within the pricing. But if it's unexpected, we hold capital. We don't charge you for it. So, now, what does have risk to do with it? Let's first determine and identify risk. Risk is, according to ISO, is actually anything positive or negative. Like you said earlier to my colleague Hamid, is that there should be challenges and opportunities. Exactly. The same case with risk. You see, as risk managers, we don't only look at the risk side, we do look at the positive, because sometimes the positive can make the bank more profitable, and instead of always increasing our capital, you never know, we might actually decrease it and make more money. It depends on our decisions, our lending, our capital allocation. So, risk is negative and positive, but we refer to the positive as an opportunity, as I said earlier. Now, what is sustainability? Now, you know what is sustainability. I've said so many times the definition today. Sustainability is the development that meets the needs of the present without compromising the future of the future generation to meet their own needs, which is intergenerational equity. But for enterprises, what does that mean? For enterprises, it means, as I said earlier, continuations. And how do we continue? We have to adapt to strategies, activities that meet the needs of the enterprise. And the way to do this, we have to have enough capital. And that's why, if you think about it, banks are merging because they want to increase their capital to do more activities to survive, to stay profitable in a competitive world. Now, that being said, the biggest mistake we did as risk managers is that we used to look at risk on a backward scope. Hence, we couldn't catch big risks such as COVID, for instance. However, as Kaplan states, we have to look forward Forward, my favorite way to look at forward is for you to open the global risk report, which tells you the top risks that might happen in the next 10 years. And it's not surprising, the most frequent color in the top 10 years is the green color, which means as banks, we cannot draft strategies without talking about environmental risk. Now, the 2-year risk keeps changing. Last year was misinformation, disinformation, which was AI, and this year it changed to geo-economic confrontation, which we already see signals that it's happening. So that being said, what is the research problem? In order for banks to remain sustainable, we have to incorporate environmental risk, not only in the capital, but also in pricing, in our allocation decision, who we give loans to. Positive screening, we have to filter our decisions. Assessing the level of capital needed is not an easy decision. Many banks around the world, they have been trying to do this, and currently this area is understudied. Many try to proxy environmental risk, so some use the pollution rate, the temperature rate, carbon pricing, which I will all look at in my research. So, research objective, to identify the impact of environmental risk on the capital structure and capital adequacy ratio. What is the capital adequacy ratio? Is to assess how much capital we have aside. So in case risks happen, we can still continue going concern, survive. To quantify, objective 2, the impact of environmental risk on the pricing of loans. And interestingly, I will tell you how I'm planning to do this, so let me know post the presentation if you agree with my methodology. Number 3, to evaluate the speed. You will notice that many countries, they still treat sustainability as tick of the box. So I'm planning to basically assess the speed of adjusting their capital to environmental risk and in which regions are doing so. And our objective 4, to assess if environmental risk influences their behavior and portfolio allocation. Now, many banks, they say it's not impacting their behavior, but again, there's another research which should be done. In my humble opinion, I think mergers and acquisition is directly related to a behavior based on these upcoming. But the way I will measure it in my thesis is how they're allocating their loans to different industries. So these are the research questions which are aligned to the research objectives. Now, what are the research significance and contribution? Theoretically, we as bankers, I must emphasize, we usually underestimate theory, but theory is the basis of how we do proper banking. And I am planning to try not build the foundation, but contribute a bit theory of how we can do things the right way, building on past research that has been done. Empirical contribution to give evidence that, yes, bank capital structure is getting impacted by looking at the adjustment dynamics, by comparing capital 5 years ago with capital today and see how it's been changing. Methodological contribution to examine how it's methodologically changing. Again, we will talk about this. And to give a policy recommendation to regulators. I think this is very important because sustainability is a private journey. It's specific to each country, how we apply it. We have different environmental risk. We cannot just follow suit as other countries. So what I have done, I did a systematic literature review. So I downloaded the paper, and as I said, it's understudied. So I got only 72 publications, which I filtered against the top ranked journals. And I filtered it down to 11. Surprisingly, my favorite journal did not cut the criteria, so I will be not considering it for my thesis. However, if you can see, I put all the papers, the findings, and the identified gap. And most of these identified gaps, if you see, focuses on stress testing, that we're not just doing it the right way, or capital buffers. So this is the where I'm going to do this. I will factor in physical and transition risk. So I started with my first chapter, which got already published with Ahlia, which focuses on the pollution rate. So I took the pollution rate and I compared it against the countries, banks that are residing in those countries, and I saw the impact on the CAR ratio, and I tried to draw findings from these. If you see, once the capital changes, it will impact loan pricing and will impact the risk behavior, and then I can do the dynamic calculation. So for disclaimer purposes, I have just done, at the moment, I reached to the pollution rate, which is objective 1. So these are the objectives and the methodology. So objective 1, I took the pollution rate, and I'm planning to expand that to the temperature. And then 2, I will do the loan level data to quantify the impact, panel regression to changes in risk allocation, and find number 3, to do a dynamic, so to compare capital before with the current capital. Now, this is the methodology for objective 1. These are the parameters. So the independent is the environmental risk, and you will see the dependent is capital. The control variables is NPL ratio, non-performing loans, the size, and the profitability, which is return on assets. Now, I know for some of you, you might find these terminologies a bit not familiar, but just to simplify it, the control variables are bank characteristic that might impact the capital size, and I'm trying to proxy the pollution, how it will add beside these parameters. So the finding, I discovered that yes, profit does impact banks' capital. Liquidity is still significant. The NPL, of course, the higher the NPL, the more we need capital. Surprisingly, bank size, not significant, because sometimes bigger banks, they hold less capital. And environmental risk at the moment, and trust me when I say this, I did all the banks across the world, 4,000 banks, very low significance. They don't hold enough capital yet to pollution rate. And these are the references. So thank you for listening to me.